when countries put all the resources into building pyramids, which is what those are essentially, and they have yet no revenue from a pyramid, you get no revenue from a ghost city, eventually the system breaks down. I don't care how much money the Bank of China is going to print. The reality that your real resources are trapped in these assets that don't produce anything. So I think for the commodity story, the Chinese market is key, especially a lot of the stuff, again, it's all, the bank system is borrowing short and lending long, and you look at these wealth management products that turn over every year and they lend out to these long-term assets. So you know what's happening, you know it's going to blow up. Is it the trigger? That's a harder question. I mean, the trigger could be a pension fund in the US. There's so many that are bankrupt. It could be a European bank, it could be Deutsche Bank, it could be Italy, it could be any number of things. It could be commodity projects in Latin America that people have invested in on the China story.
Dan Oliver is a very different thinker in the gold space. He runs a small cap gold fund, but the way he writes about gold and credit throughout history has made him someone that I've been looking forward to interview for a long time. And I know, judging by the comments, a lot of you guys too have been looking forward to hearing from him. So finally, we're here in New York. We're going to sit down. I want to talk to him about history, which is a favorite subject of mine, and gold and its place in there, and also get a sense of how he manages to run a small cap gold fund, which is a big ask for anybody. Dan Oliver, CEO of Myrmikan Capital and the president of the Committee for Monetary Research and Education.
Yes,
Did I get that right?
Yes.
All right, how
Very
about
good.
that?
Very good.
I don't like welcoming people to New York when they live here and I don't, but welcome to Real Vision anyway.
Thanks so much.
This has been a long time in the making, and our comment sections on pretty much every gold video are littered with, you got to get Dan Oliver on, so I'm glad we get to make this happen.
Very flattered.
So there's a ton I want to talk to you about today, and much of it revolves around gold, but specifically around history, because I've read a lot of work. I'm a real fanboy, so I've read a lot of the way you write and the way you think, and it really speaks to me. But before we get into that, I want to go right back to the beginning, which I love doing, just to get a sense of people's stories, because yours is an interesting one from what we've discussed off camera. So take us all the way back and walk us through it.
Oh goodness, well, I got my start in commodities in Argentina in 2007 and 8, and a friend of mine invited me down to work with him in his private equity firm, and I knew nothing about commodities. My Spanish was lousy, but how can you turn down?
And you were a law student, right? You were.
Yeah, I went to Columbia Law School here in New York, practiced law for 2.5 years. Wasn't my thing.
That's the wrong time to find out. You need to figure that out before you do the law degree.
Had I been smarter, I would have been 2.5 weeks. So my more successful colleagues figured it out. But so I went to INSEAD for my MBA in France, and had a fantastic time in Paris and Singapore, and met a lot of interesting people. And it was actually because I didn't pass the Spanish requirement at INSEAD that I went up in Argentina originally to take Spanish lessons. And a friend more clever than I was discovered that it was cheaper to get into a taxi and sit there than to pay a Spanish tutor. Right. So you'd hail a cab, it was so cheap in 2005, so you'd hail a cab and just wander around for an hour. And a lot of them were university professors who lost their pensions. Amazing. So you'd wait some guy with a tweed jacket, you'd hail him down, you'd hop in a taxi, and then just chat with him while the meter's running. It was fantastic. So I passed the test, moved back to New York, worked for my brother. We had a stuffed animal company and a factory in China. We sell stuffed animals around the world. It's a lot of fun. And while I was doing that, a friend of mine from Argentina called up and said, "Come work with me down here in Buenos Aires doing commodities." And again, I knew nothing about commodities. So
what made you say yes?
Adventure.
Right.
Really adventure. I mean, it seems so romantic to go make your fortune in the Pampas.
Right.
Of all the places to do it. So why not? And I'd lived other places. As I mentioned, I took a year off before college and moved to Paris and worked at the Herald Tribune for a year. And learned about the world from these old grizzled writers. That's where writers go to die. Hemingway. They all want to be Hemingway and Fitzgerald living there. It's not quite the reality, but it was more so when I was there. And I spent some time at Oxford. And so I have a bit of wanderlust, I guess. So here I was with the opportunity to go, back to Argentina.
How do you say no?
Which I love. How do you say no? And of course it was crazy. I mean, you're in finance. I mean, 07, 08. The economy and the housing market were really rolling over in the first world, but commodities were hot until mid 08. Ships, iron ore, all those things. So we were down there looking at a lot of the projects. And as I said, I was a complete neophyte in this space. It's just things go up, right? That's what they do. They go up forever until they don't. And that's what happened, of course.
But how did it feel, though? Did you get that sense? Because I've lived and worked in Asia, and sometimes when you're in those little bubbles, as an Englishman abroad, you get a sense that the rest of the world there's stuff happening, but it's hard to connect the dots when you're not actually experiencing it firsthand.
Yeah, I mean the whole story when I was there is that China was modernizing. Yeah. Right. There's 1 billion plus people in China, 100 million middle class people, and the other 900 million will be joining that soon. And so therefore, it puts pressure on everything. Copper, iron ore. They eat up the food chain, so soybeans get bid, and cattle, and everything goes up. And this was a mega cycle. It was going to last for 40 years, the way when the U.S. industrialized. Yeah. Around the turn of the previous century, this would go on forever. And so the idea was that the sky was the limit and it would go forever. And of course, I didn't know at the time, but the U.S. did industrialize, and along the way there were huge crashes that wiped everybody out along the way. Railroads bankrupted everybody and commodities multiple times. But I didn't know that at the time. I was skeptical, but I didn't know enough to know why I was skeptical of what was happening. And what I really took away from it, and I've really played on later, is that it's the marginal asset that really has the operational leverage, right? So we were looking at a ship that was on the way to the scrap heap, but someone needed a ship for 2 years, and there just weren't any. Yeah. And so it sold for $10 million on a 2-year charter. This old, bedraggled, leaking ship, because there simply weren't any. And of course, a few months later, the dry bulk index went from $189,000 a day to 8 or something like that. Now that's the spot, not most of them on long charters, but the point is that the market completely collapsed. And it took me a long time to digest what had happened. That's what led to what I do now, was that process of trying to figure out what did I live through? What was this incredible event I saw firsthand in Argentina, where it was on the commodity space just as violent, if not more so, than in the housing market.
So how do you go? Because I've spoken to lots of people, and it's always interesting when these events happen, and I've spoken about this before in Real Vision, how the point where you enter these markets determines a lot about your career, and certainly the things that happen to you in the first few years. It really sets your mind, because I joined the markets right before '87, so having the markets lose a quarter of their value in a day showed me firsthand, with a good clip around the ear, that can happen. So I've been aware that can happen ever since.
You're very lucky.
No, I think it was, because that was down and up. That was great. It wasn't a painful, drawn-out process, but you suddenly realised, okay, my range of possibilities just did that. Yeah. And I'm prepared now to countenance events. So when you do this, you go into Argentina and you see that boom and bust in the space of 6 months, 8 months probably? Yeah. How does that affect your mindset?
Well, I'll tell you the way I reacted was, when I had been in law school, I had worked on a project for a professor to do with the pattern industry, the catalog industry of the 19-teens. And research, this was in the late 90s, researching the source material, reading the Wall Street Journal and the New York Times in the 19-teens. And I came across articles saying things like, in 20 years, there'll be no more retail stores. This is 1999, I was reading this, and I thought, well, this sounds very, very familiar. Right? Yeah. Or Bob's hardware store thought it was too small to have a catalog. We showed him he could have one, expanded sales. Again, this sort of triggered recognition from things I was reading about the internet. And what happened in that episode was, of course, catalog companies were the internet darlings of the day that did fantastically well. The panic around 21 bankrupted most of them. Even the survivors, the big boys, Sears and so on and so forth, went down 90+%. Yeah. And if you bought them at the bottom in 21, you actually did much better than had you been speculating them in the teens, because the base was so low. And so I formed a thesis, this is in '99, to start a fund, wait for the crash to come, and then pick off the internet survivors after the crash, and just assuming history would repeat itself, and not knowing anything about Austrian business cycle theory or any of that stuff, just the analogy. Of course, that's exactly what happened. It turned out I was a first-year lawyer at Simpson Thacher, and I was not in no position at all to start a fund or do anything like that. So the opportunity passed me by, and after coming back from Argentina, I was self-consciously thinking, can I find another historical analog to what I had seen in law school with the catalog industry in the internet? And so I started reading books written in the 1930s, not about the Great Depression, but written during the Great Depression. Yeah. You get a very, very different perspective Books written about the Depression are very clinical, and they have charts and graphs and neat conclusions. Books written during the 30s, they had no idea what was going to happen.
Yeah.
It was just the end of capitalism. Was Roosevelt going to take us fascist or communist, or what was going to happen? And those books talked about depressions and panics in the 19th century, which I was totally familiar. And so that commenced the intellectual curiosity.
Yeah.
And it wasn't, again, there was nothing intellectual about the connection. It was more the stories and the words I was reading in these long ago texts that seemed so familiar to what I was reading in the Wall Street Journal in 08,
Well, history walks you backwards. If you let it, it'll walk you backwards, and you find so many parallels to your point that have happened. I mean, this has all happened before, all of it. I mean, we can talk about the extremes and degrees to which it's happened, but it's all happened before.
No, exactly.
So when you kind of do that, and it's interesting that you had this idea and it played out like that.
Yeah.
And you missed it.
Right.
And then you find yourself, of course, the next time you have these ideas, they never play out like that, right? When you're ready for them, it takes time.
Yeah.
So how did you then make that next step to actually doing something about it?
I learned from these old texts. These were not economic textbooks, mind you. These were journalists and people writing about the time. That gold always does well in a post-bubble contraction. And I didn't quite understand why at the time. I mean, it had to do with money printing and the crash. I couldn't put the pieces, but I knew that much. And so I thought, well, if you like gold, right, having lived through the experience in Argentina, why not get involved in the marginal gold mines? Because that's where the most play is in the gold bull market. And again, you can see this in the data in the 70s and the 1930s that this works. And so I set my firm to speculate. I don't invest, I speculate in junior gold mining companies as an form of economic insurance. And I had no idea at the time how long it would take.
Yeah. Or how ballsy you had to be to do it.
Yeah, well, that's right. I mean, usually in these previous panics, once things start to cascade default, you get cascading defaults, A defaults to B defaults to C, it just collapses. And the Fed, to its credit, no pun intended, did stop the collapse. They suspended mark-to-market accounting. It wasn't the QE so much, it was the guarantees. People forget they guaranteed, I forget exactly, it's $6 or $7 trillion in that period in 08. So why would you have a margin call on your client if the Fed's guaranteeing them? You don't need a market to market. I mean, you don't. And so that did stop the panic in its tracks. And then, of course, the QEs helped reignite an even larger bubble that we're living through right now. And there is a precedent for this. Same thing happened in 1837, 1839. There was a panic in 37. Banking being lowered rates. Everything was rosy again. And then 39 it crashed for good. Yeah. It was much quicker than the 19th century because of the gold standard. Yeah. And the fundamentals aren't any different, but certainly they can keep it going longer and further and higher now with a fiat currency than they could back in the 19th century.
So when you... Something must have kind of brought you towards the Austrian School of Economics, for example. There must have been a moment where, was it just something when you're reading all these books that spoke to you, kind of made sense, or? Yeah,
actually, it was very fortuitous. I'd read all these historical treatments with no theory attached to it. So I sort of got used to the pattern without any understanding why. And then I was in my parents' library opening up Road to Serfdom, which I'd never read, of course, because I went to all the top schools. They don't assign these things. Right. And out of the dust jacket fell von Mises's obituary from 1972, I think, or 3. I'd never heard of him. I read the obituary. I thought, this sounds very interesting. And so I went and started reading his books. Started at the beginning, started the books he was writing before he became famous in the 19-teens in Austria. And it was like, this is it. I mean, this is what's happening. And then, of course, I discovered the von Mises Institute and all the materials they have. And what's great about the internet is you can educate yourself. Who was it who said once you learn how to read, you're responsible for your own education? Right. And it really is the case. And especially people with capital ought to care. I mean, they ought to want to educate themselves. If they don't, they'll lose their capital. So it's a serious game. I like reading about Caesar too, but it has no practical relevance today, really. Whereas when you read economic history, it has great practical relevance for today.
Well, I mean, the story of money and all its booms and busts is the story of humanity. I mean, we follow that money cycle. I mean, you can argue the money cycle follows us, but either way, they're so pathologically entwined that, I mean, this is why it all made sense to me, because you watch it and it happens over and over and over and over again.
I found a passage in Tacitus, the Roman historian from the 1st century AD, where he talks about the panic of AD 33. And what he says is that due to a disturbance in the money market, the Emperor Tiberius took 100 million sesterces out of the imperial treasury. He lent it to the banks at no interest for 3 years against real estate collateral.
Right.
And you read that and you think, that's TARP. And Paulson never credited Tiberius with the idea. And I've never seen that written anywhere else. I mean, it must be written up somewhere, but I've never seen it. And you think, you read that, and again, without any theory at all, and you think there's something going on here, and what is it? And that led to, again, to the intellectual aspiration of figuring what the hell connected two events separated by 2,000 years. And as you say, it's human nature, but it's also the nature of money and credit, which really hasn't changed much in the last 3,000 years.
Nor I mean, credit preceded money. There was credit before there were coins. I mean, this is the interesting thing. But you, the way you write about gold and the way you express your thoughts, it's different to the way most people do it. This is what drew me to your work, just because it's like, okay, here's a guy that thinks about this a different way. It's not about the price of gold. It's about history and relevance and repeating cycles. How did you find, when you do that, because you talk about the internet being this great source of knowledge, when you put yourself out there like that, what was the response you got?
You mean to my original work?
Yeah, when you started writing.
Yeah, the first stuff's terrible. It's on my website. I should take it down because I didn't really understand it. Right, it's been a journey myself, and
that's the great part about doing this writing stuff, right? Is to get your own thoughts and try and figure out what you think first.
True, and the discipline of doing it every month does train you as well. I was never a good writer at school. I didn't really see the point. But once you're doing it as a profession for an audience that wants more, and you do it, every month, you get better at it. But to answer your question, I learned about gold from people who've been dead for a century or longer. I mean, no one teaches you about it here, and I do find that much of the modern commentary is either hysterical on the gold bug side, or else very dismissive on the Keynesian side. They just again, I think if you advocate for the gold standard, that you're part of the flat earth society, and they won't engage you because it's just too craziness. And of course, you think to yourself, again, man has been wrestling with these ideas for at least 3,000 years, probably longer. And we've had this system we've had now post-Bretton Woods for 40 years. Yeah. And they act as if the first 4,000 years were completely irrelevant vis-a-vis the next 40. And there's the first real modern bubble was the Mississippi bubble in France in the 17th teens. The Duc Saint-Simon wrote a treatment of that in his memoirs, and what he talks about it gets extraordinary reading it. He said it was pretended that since the time of Abraham, all the nations had been the greatest error concerning money, that only paper was necessary. And there you are 300 years ago, and they're saying the same thing. Paper is all you need. Gold is anachronistic. And it worked for 3 years.
Exactly.
Again, it was less sophisticated. It blew up much quicker. I found a paper that the Federal Reserve published in 2011 that says that John Law's system could have worked had they just managed it better. That he was on the right track. For 200 years, that was the epitome of bubble. That was exactly true.
Schumpeter still said very famously that John Law was one of the finest economic minds in recorded history.
Well, reading his stuff he was very avant-garde. I mean, Menger gave him credit for the liquidity theory of money. Hayek was very, and I've read his stuff, and it's very good. But he made a couple of key errors, which led to, which, by the way, our current structure is repeating.
Of course,
and it's just amazing to me that again that the quintessential bubble is now held up as a system that could have worked.
Isn't that because it kind of has to be? I mean, if you admit that it would never have worked,
right?
What are we doing? Right?
Exactly.
And that's the problem to me. It's that disingenuity of, and I think John Law had the same problem. Once you get to a certain point, it's all about protecting your legacy and your scheme and keeping the thing going, rather than you can't go, you know what, this was a bad idea. We can't do this. So, and I think that's kind of where we are now. It's like, well, we can't say this won't work or would never have worked.
He escaped France dressed as a woman.
Right, exactly.
I keep waiting for Bernanke to try the same trick when the thing blows up.
Well, the beard will have to go. That's for sure.
Exactly.
Well, look, it's fascinating. But when you have this thirst for an understanding of something like gold, which has puzzled men for thousands of years. Like no one's ever closed the book and said, right, I understand gold now. This is great. What's next?
Wait till mine comes out.
Right. Well, yeah, the sooner the better, frankly. But to go into the junior mining space,
yeah.
I mean, that is the act of either the bravest man in the world or someone that really thinks this is a great idea. You must have learned some hard lessons doing that.
Oh, sure. I mean, Mark Twain, as we all know, is attributed to saying that a mine is a hole in the ground with a liar standing on top of it. And the junior mining space. I found a book called Fleecing the Lamb about the Vancouver Stock Exchange. It's written in the mid-'80s, and it goes through all the different scams that have gone on in that exchange, and there are many. And what was frightening was I recognized a few of them recently.
Yeah, I'm sure.
So again, human nature doesn't change, things don't change. And the way you have to navigate it is relationships. And that's really true with any business. But I think in some commodity business, more mature businesses, you can do that less. But certainly in the junior mining space, it's all about relationships and who you know, and knowing the people you're investing with are above board, and also understanding that it is risky. I mean, the seniors make big mistakes.
Yeah.
It's just a volatile business, and so I think having a broad portfolio is very important, much more important than a normal stock portfolio. I mean, it's always the possible that you wake up one day and the CEO has been arrested for embezzlement. That's always possible, or the patent got overturned or something.
Yeah.
But it's rare. Whereas, a mining company can have the mine collapse.
Yeah.
Or the grade just wasn't there. Or, I mean, it's a much more volatile. On the upside too, right? They put some drill hole in and the thing goes up. So it keeps you awake at night, certainly.
How do you go about, I mean, I start with the management. Whenever I look at these companies, that's my starting point. And I research them before I even, frankly, look at the grade or the reserves, any of that stuff. But let's assume that these guys pass the smell test and you do work. How do you go about identifying which companies you want to invest in?
Again, I have a particular point of view because of my strategy, which is that this is not somewhere you're going to put all your money. This is economic insurance. And so by its nature, you're paying a premium, essentially. And by its nature, premiums decay, as these companies do. It is the case that in a bubble, gold underperforms other assets. And there are reasons why we can discuss later if you like. But that means that gold mining margins get suppressed during bubbles. And so gold mining is a terrible business most of the time because bubbles grow very slowly over long periods of time. And then you have these periods when bubbles collapse and gold goes crazy in terms of commodities. Margins explode, and the gold mining has 2 or 3 or 4 years of incredible growth at the very time that the general market is melting down. And so it's this wonderful negative beta asset if you play it right. So I look for companies that are really going to play into that dynamic. So, for example, one of the things that characterizes a credit collapse is, of course, credit. Right? You can't get credit. Yeah. So if you're investing in a highly levered gold mine, that can be a big problem, obviously. Now, if the debt is due 6 years out, they can probably survive that. And I like those. If the debt's being rolled over next year, well, that could be a big problem if you blow up during that time. No one lends money to development companies. They don't have debt, so you don't need to worry about that dynamic when you're investing in a development company. That said, I mean, it is true that in a market panic, of course, a lot of the holders holding these things also have to sell.
Of course.
And so usually gold mining companies get slaughtered along with the market at the initial crash, and they bounce up really, really quickly afterwards because the economics support them so well. And that's what happened in 2008, right? I mean, gold miners got absolutely crushed, but in just a couple of years, they were screaming higher. They started going higher immediately. In a couple of years, they were much higher than they had been. So it's a very tricky game to play, and it's volatile. But it's volatile. It should be volatile with 2 or 3% of your portfolio, not with all your money.
Yeah.
And one of the things Mark Spinagle talks about, which I think is very useful to keep in mind, is that if you have a rebalanced portfolio, so let's say you own the S&P 500, and you decide, okay, every year I'm rebalancing that thing with, for example, 37% the Barron's Gold Mining Index. You actually increase, even though that index has actually massively underperformed over time, the gold mining index, by adding it to a rebalanced portfolio, your portfolio way outperforms the S&P 500. And the reason is because your drawdowns are so much shallower.
Yeah.
And so you compound over time at a much higher level. And so it's weird because investors always want to always think initially, I want the highest yielding asset I could find, obviously. I mean, that's common sense. But in fact, adding a negative beta asset to your portfolio, especially when it's very negative beta, right? You put relatively little amount in it, can have dramatic effects for the long-term performance of your overall portfolio. But it's a hard thing to get your head around, right?
It really is, yeah, it really is. And most people struggle to do it, which brings me to the question of investors. Like, how do you pitch this idea to investors?
It's just like that. I mean,
but you have to find a certain type of investor, because especially now, in a market like this, everything's going up forever. They don't want to hear that.
Put it this way, you can't pitch to agents.
Right.
No agent can take that kind of risk. They invest, it goes down, and they lose their job. Right? So you invest to principals, people who understand this and want the risk. And some people don't agree with the thesis, but they say, I don't agree with it, but gee, I want some protection cases.
Yeah.
I don't think my house is going to burn down because I don't smoke and I'm pretty careful. But you never know, right? And that's, I mean, it's pretty simple, and the thesis is pretty simple, and that is. Again, I try to go away from gold particularly because gold doesn't do anything. It's as a metal, it just sits there. It doesn't oxidize. It doesn't. As Warren Buffett tells us, you fondle it, well, it won't respond, right? Just dirty old man. But it's what happens around gold that's interesting. Right? The reason gold is money is precisely because it has the most stable value of anything man has ever found. And there are lots of reasons for that, again, because it doesn't react, because of its density, because of its beauty, because it's a metal, so it's infinitely divisible. It melts at a low temperature, low melting temperature, so you can divide it and put it together again. And also because mining it is so difficult that it keeps the supply of it coming into the market very, very constant. And so for all these reasons and more, which again in the 19th century they were well aware of and understood, gold has always been money, capital. But buying goods with gold is very difficult. If you go buy bread with gold, I mean, the amounts you're talking about are very, very tiny. And that's why silver was a transactional metal. And one of the key insights that the Austrians bring, especially called Menger, was that moneyness is an attribute. It's not a thing. And so again, for thousands of years, you had a bimetallic system where, for very natural reasons, gold was used for capital transactions. And for savings, and silver was used for transacting, and copper for subsidiary coinage. And this went on for thousands of years. And what really undermined that system was the development of the non-counterfeitable banknote in the 1880s. And also in the age of classical liberalism, you could actually count on that banknote being redeemed. And so it solved gold's illiquidity problem for small transactions. And so you really get the real gold standard from that point in history to about the World War I. It only lasted about 30 years. And my goodness, those 30 years were, I mean, the 19th century, it's incredible to me. People like Keynes and Krugman look back at it and say, oh, it was so terrible, the individual was awful. Yeah. You think about what the beginning of the 19th century looked like. I mean, outhouses, square riggers, leeches, right? Your leather belt instead of anesthesia, right? And 100 years later, you were on the Cunard liner having your caviar going across the Atlantic, and there was a telephone instead of a horse and rider. I mean, it just the transformation was just incredible, and it was done through free markets and mostly free money. It wasn't entirely free, where it had been, but it certainly was much freer than it ever had been before and has been since. And we saw that huge, unprecedented leap in the material living for the lower classes. I mean, like, if you're in the elite, it's been great. It's always been great.
Of course it is, yeah.
Right. But it's the middle class and the lower classes that benefit the most from the gold standard and from having sound money. So that's gold, and what happens in our system, and this happened a bit in the 19th century, but to a lesser extent, is that the banks show up, right? And the banks lend against assets. And they didn't used to, by the way. You know, banks, as originally formulated in the free market, finance commercial bills, right? They finance circulation capital. So the wheat passing through the miller and the baker, not the ovens and not the mill. Those are assets that savings finance. The banks only finance the circulation capital. And it's actually an interesting point. If a bank tried to finance fixed capital in a free market, it overissues its currency. The currency falls in the market. Speculators buy it up and go redeem the gold from the bank.
The gold, yeah.
So the bank gets drained of capital. So you don't need any bank regulation. You don't need a central bank. The private market does it also. And in fact, the banks themselves in the 19th and 18th centuries were the primary enforcers of this, because they would accumulate the notes of rival banks, then show up one day and say, here they are, redeem me right now. And the only defense was to keep very liquid assets on hand. And this was undermined basically to fight wars, right? The Federal Reserve was founded in the system that it was not permitted under its original charter to monetize anything other than commercial bills of 90 days or less in duration. And this was changed in order so the Fed could finance the banks that were buying government bonds for the war effort. Same thing happened in England during the Napoleonic Wars. And then there was this idea that, well, gee, why don't we do for the purposes of peace that which we learned to do for the purposes of war? So that system was kept. And there are two outcomes of that system. One is the boom-bust cycle we have. Because when banks finance assets, what happens is the asset goes up in price. The bank feels itself more collateralized. So they'll lend more money against that same asset or a similar one, like a house. Right? And so the price keeps going up and the banks keep financing it and without limit, essentially. And what happens is you get huge overcapacity in housing. Houses were so much, everyone starts building them, right? And then that suppresses the value of these things. And now those projects can no longer pay their interest payments, the banks blow up. And of course, it's maturity transformation is such a nefarious thing. You put your cash at the bank and it uses it to fund a 30-year asset. Yeah. Right? And the idea is, of course, well, no one shows the money all at once. Well, they do when the asset stops paying its interest payments, right? And then you get a panic, and then the Fed shows up and bails them out. Of course, in the 19th century, they were collapsed, and that's what kept the system much more on par than now. So it's a pretty basic story, and the point of gold is that it resists that, right? As interest rates start going down, as banks start monetizing assets, the longer term your cash flow is, the more affected it is by discount rates. Yeah. Right. So lowering the discount rate makes long-term projects like buildings and ships and airports and shipyards seem really, really valuable, and everyone starts building them. And then again, when they can't pay their interest payments because no one actually wants those things, it blows up. Which is why you see at every collapse, whether it's the Asian crisis of the late '90s or Brooklyn in 2008, you see half-built buildings, you see half-built big assets, half-built base metal mines playing in the story. So gold doesn't participate in that. It has no cash flows. It's not demanded in industry. It resists this boom-bust, which is why it always underperforms during the boom and why it always outperforms in the bust. So that's the credit cycle angle. But there's an even more nefarious, to me anyway, aspect of that. And that is, in a system in which the banks are financing assets, right? The more assets you have, the better your credit terms are. Yeah. And so if you look at, for example, in the US bank system since '97, which is as far the data goes back, loans for over $10 million are 2.5% less in interest than loans of $100,000 or less. So what happens? What happens is the bigger you get, the lower your cost of capital is. Yeah. So the more competitive you become, right? And the more able you are to buy up pesky rivals that you can't underprice. And so there's a natural tendency of this brand of capitalism, of this banking system, to concentrate economic power, which is why you see huge companies that are always merging and bigger and bigger and bigger. And it also is why index investing has worked so well. I mean, only 20% of managers beat their index, and the reason is the indexes are capitalization weighted. Yeah. So they're investing in the biggest companies that do the best in the system. But for all their efficiency and all their scale, they become very inflexible, which is why when you call companies up, you get a dial tone thing, it takes you, and you call it chase, it takes you like 4 layers to get someone after 20 minutes, and you've just given up at that point and done something else. What struck me about this thesis is I was reading, believe it or not, Vladimir Lenin's book he wrote in Germany in 1917. And he talks about the exact same thing. In fact, he even talks about the fact that in the panic of 1900 in Germany, who knew there was a panic in 1900 in Germany, the banks used the opportunity to concentrate industry even more. In other words, they saved their big clients and they let the little ones go, which is exactly what happened in 2008. So every panic that comes along when the Fed bails out the banks and they bail out their big clients has this effect of concentrating industry. And it's terrible for consumers because, again, you get these very big, inflexible corporations that run our lives. It's terrible for workers. I mean, the Amazon worker is the end result of the system, right? Your job is to take it out of the basket and put it in the box. And soon a robot will do that anyway. And so it's a dreadful system, and it survives only because of this banking system, and it eventually blows up because consumers don't want this. They don't want these long-term assets. They don't want these huge corporations. And I see it in New York. I mean, New York used to have a butcher shop in every third block. Now there's a Whole Foods financed by Wall Street, and they've all gone in business. France, the beauty of France, every little village had a charcuterie and a boulangerie and a fromagerie, right? Everyone all knew each other, and you went in. Well, they liberalized their banking system according to the Anglo-Saxon model of the EU. And what happened? Now it's the Carrefour.
Carrefour, yeah.
You get in your car, and why? Because they have huge real estate holdings. They've got massive collateral. They can borrow money cheaply from the banks that the little guy can't. And so you have this hollowing out of the small town. And so this credit system is nefarious in lots of different ways. It creates huge disparities in wealth. Which capitalism does not. I mean, capitalism operates to break down disparities of wealth. Right? Innovation removes the bottlenecks to scarcity. Right? If you own a whaling ship, it's great, you're rich until some guy digs a hole in the ground in Pennsylvania, and the oil production goes to the roof, and your whale ship isn't worth anything anymore because there's more oil now for everybody. And that's the way capitalism, through innovation, breaks down hierarchies.
It's interesting that you differentiate between the two, because we're when you talk about these half-built buildings that all go away, we didn't really see that after 2008. Excuse me. We had all the cranes everywhere, and we had the buildings.
Right.
But they flood the system with more credit, so people can come and borrow money, take over the buildings, finish them. If anything, there seems to be more cranes now. Wherever I travel around the world talking to people, and every city I go to, I'm looking at the cranes, and they're everywhere again. Yeah. But when you read the commentaries and you read the people who are not Cassandras, but the people saying, something's wrong here. This can't go on forever.
Yeah.
They all talk about, are we reaching the end of capitalism? They all say, this could be the death knell for capitalism. And to your point, it seems we kind of strayed from that a long time ago. And this is not capitalism.
This isn't capitalism.
Right.
I mean, capitalism is free markets, is freedom and liberty. And it's bizarre to me that Milton Friedman and the monetarists, who he was a wonderful spokesman for free markets, everything except money.
Yeah,
and money's the most important market there is. And this idea that the government, the state, needs to control money. Again, it was introduced as a way to execute warfare. I mean, that was its genesis. And it is a martial command and control system. It's not capitalism, and the sooner this system goes away, I mean, the better. Now, the scary thing is what follows it.
Yeah.
When you get these big crises, again, you look back in history of other times and other places. There are two paths you can take. You can get the strong man who makes the trains run on time, and that's what Germany and Italy decided to do. Or you can do what Germany did in the late 40s and just let the whole thing go, just let it collapse. And Jacques Rueff was in Germany when I think it was Erhard. Let all the Allied capital controls and price controls disappear, and they didn't know what was going to happen if people could eat. And they said it was even the supporters of free markets were shocked just how fast the recovery came.
Yeah.
Once the economy was unfettered. And,
well, it's funny you read things like Jim Grant's book about the crash that cured itself, right?
Yeah,
when people just stepped away and let these things happen. And it's funny. You go back to 2008, and all you can remember is, if we don't do this, the system's going down.
Right. Good.
And the counterfactual is what? Because we don't know. I mean, I'm sure it would have been awful, but it might have been awful for 6 months or a year.
Yeah.
And you have this clearing event.
That's right.
But to take that away and then claim unilaterally, there's no need to thank us, we've saved you. Right. It's disingenuous at best. And I understand why they did it, for social control and cohesion, all that stuff. But you just don't know.
Yeah.
And history would suggest frequently that allowing the system to purge itself is in the long-term interest of everybody.
Well, again, that's what happened in the 19th century. The cycle was the same, but there was no mechanism for them to bail out the banks and the capitalists and the employees, all the people, and so it all liquidated. And it liquidated, right, down to its most liquid form, and then people would husband their resources, could pick up the capital and run with it on a more sane basis. But now the 08 was about bailing out Goldman Sachs and the rest of the boys on Wall Street, and they've gotten richer than ever. Although even the banks, of course, it's become even more hierarchical. They need fewer little bankers running around doing deals because they do these mega deals and they have these systems that work, and the shadow bank systems are enormous. That the top guys are richer than ever, but the participation in that system is actually falling.
Yeah.
Which again, I don't shed any tears over that, but it is reaching the end game. I mean, I think so. When you look at all the graphs on the Federal Reserve website of money, figures, and credit, I mean, there are all these incredible power curves, and you think this is not. You don't just lop off 2 zeros and keep going, right? They're actually accelerating to the upside.
But I guess the counter to that is you also don't have to let them run to today. You could lock a year off, they still look bad. 2 years off, they still look terrible. I mean,
but they're accelerating on the upside.
No, absolutely. Because I guess they have to.
Yeah, they have to.
But when you look around the world as someone trying to invest in gold and gold mining stocks, and you understand the forces that are going to make those investments that you make pay off,
right?
I mean, they're aligned against you because everyone is trying to stop this natural event happening.
Exactly.
So how do you deal with that in terms of someone that has to manage money, manage risk? How do you deal with that?
It's tricky because again, when you're historically minded and you're reading history and something happened in 1836 to 34, who cares? I mean, 2 years.
Yeah.
Who cares? When you're living through it,
9
months or a year, that's a long time, and it's a long time to be carrying a huge. A loss in a position or something, knowing that what's going to happen, but can you get there?
That's exactly it.
And it's why I try to look at situations that don't require the spot price of gold to be in any particular place, right? So again, if you think about the lower part of the junior spectrum, where I go, some of them, if they have a big cash position, if they're activities are hiring geologists and drilling a few holes, they can stop that on a dime, which they did. I mean, a lot of these companies managed in the downturn that lasted longer than anyone expected and deeper than anyone thought was survivable, to husband their resources and maintain the claim on the asset. And that's what we look for. Can this company, in a scenario where gold dives for a certain period of time, maintain its claim on the asset? I mean, the stock price will get crushed no matter what. That's just going to happen. But will they have the claim on the asset so that when gold comes back, as it is going to, will it participate in that rise again? And so that's the criteria I look at when I look at these situations.
I mean, it's been brutal. When you look around the world, where do you see the pressure building the most in these credit markets? Is it China, which, I mean, we all see the numbers, and there's just enough opacity around them that no one does anything about it because they kind of go, well, we don't really know for sure. Yeah. Is it China? Is it the Federal Reserve intent on hiking rates? They're going to break it like they always do. Yeah. Where are you looking for a sort of ground zero for the pressure?
So, in terms of the commodity story, right, which is what I care about principally because commodities are the major cost of mining. I mean, China's obviously the center, right? It buys incredible percentages. I don't know these, half of the copper, 46%, whatever the zinc. Now they export some of that, about a third of it, but there's a huge demand for China to build Go cities and more ring roads that will be used in the future. And again, you look back at the 1850s in the United States, they were all building railroads prospectively into the Northwest because one day someone will live there. And that happened one day, but in the meantime, they all went bankrupt, of course, because they didn't need 3 railroads going into the wilderness. So that's not going to work. And when countries put all the resources into building pyramids, which is what those are essentially, and they have yet no revenue from a pyramid, you get no revenue from a ghost city, eventually the system breaks down. I don't care how much money the Bank of China is going to print. The reality that your real resources are trapped in these assets that don't produce anything. So I think for the commodity story, the Chinese market is key. Especially a lot of the stuff. Again, it's all the bank system is borrowing short and lending long, and you look at these wealth management products that turn over every year, and they lend out to these long-term assets. So you know what's happening. You know it's going to blow up. Is it the trigger? That's a harder question. I mean, the trigger could be a pension fund in the U.S. There's so many that are bankrupt. It could be a European bank. It could be Deutsche Bank. It could be Italy. It could be any number of things. It could be commodity projects in Latin America that people have invested in on the China story. right? And the overcapacity that brings in. Who invested those $3 billion in some iron ore mine that no longer pays for it? And the thing to keep in mind on the commodity side of things especially is that if you invest $1 billion or $3 billion in an enriched oil platform, that is a huge amount of capital. The per barrel cost, running cost, might not be that much. The OPEX can be very low. And so oil can go down a long way, and they keep producing because the assets still cash flowing, but it can no longer support the assets that were used to build it. And so the lender goes bankrupt even though this thing doesn't shut off. And so prices don't recover because it's still merrily doing its thing, right? And that's true for all commodity projects. Usually the big cost is the capital cost, and the marginal cost is usually quite low.
Yeah.
And this can cause real havoc in the banking system or pensions that bought or whoever bought this stuff. Subprime autos, same thing. You've got a sharply falling collateral base with a rising loan balance on it. And who buys it? Pension funds. I mean, it's absolutely crazy. Yeah. So when the private pension funds go down, politicians don't care that much. When state pension funds start going down and politicians actually start getting affected themselves, I suspect it might be a different story.
Well, it's kind of started. Kansas has done what they've done. Illinois is that close, and New Jersey and
Connecticut,
Nevada, Connecticut.
Trouble.
This is
Puerto Rico.
It's like someone's putting the dominoes down now, and watching them topple over. But the closest we've had to this, I guess, when I interviewed a guy called Diego Perea, who's a friend of mine out in Singapore, super bright guy, chemical engineer, and he was talking about the oil industry and talking about the broadband of energy, and he made the fantastic comparison saying that back in 2000, after the internet bubble burst, all the sunk capital cost went. So the railways in the Northwest in the 19th century,
right.
All the capital is sunk, the assets go bust, people pick them up, and that allows them to run railroads cheap. Right. Same with the broadband, and that's why we've got $9.99 internet a month now because of global crossing, right?
That's true.
And so, but we haven't had that event allowed to happen again because 2000 was so painful for people, I guess, that all this sunk cost, it has to be maintained, all this credit, they can't allow it to go away.
They can't allow it. I mean, that's the thing, but they have to at some point. And that's the sort of the intellectual interest is how does it play out?
Yeah.
I mean, again, I think in the long term we know how it plays out, and it plays out that these things will default either through inflation or through hard defaults. And which will it be, and how, and what's the degree, and how does it play? I mean, those are tricky questions. But the end game is very clear. And again, in terms of gold, people always want to know where's the gold price going to go in these different scenarios. And I always push back at that question because I think the more interesting question is what happens to the dollar. But the point is gold hasn't really changed in value in 4,000 years. I mean, it goes up a little bit, everything. It's not completely stable. It's just the most stable thing that man has ever discovered. And so the way I answer the nominal gold price question is, again, I don't look at gold, I look at the dollar, right? And what is the dollar? Well, the dollar originally in 1792 was a mass of gold. It was just defined as this is so much gold. Now, the definition of a dollar is a unit of liability of the Federal Reserve. That's what it is in its essence. And if it's liability, then you have to ask yourself, well, what's the asset backing it, right? And all these monitors, people say, well, it doesn't matter, just how many are there. It's just, and again, there are, Thomas Sargent wrote a paper in 1981, and he looked at the hyperinflating countries of Central Europe. And he made the point that the quantity of money they're printing had nothing to do with their value, it had to do with the assets they were buying. In the hyperinflation period, they were buying government bonds that had no hope of being repaid. In fact, the ones they had were devaluing, which is why the currency devalued more than the quantity would suggest. But even in stabilization, like in Austria, for example, after they stabilized the currency, the quantity of it sextupled. But the things they were buying were gold, commercial bills, dollar and sterling instruments. And so the quantity really matters. It's what backs the thing. And so you say, well, what backs the U.S. dollar right now? And the answer is, yes, it used to be 30-day bonds, 30-day government bonds. Right now it's 30-year bonds, or I think the average is 12 or 13 years. It used to be 2 or 3 years, 20 or 30 years ago. And these really funky real estate structures, bonds. And so it's a land bank the way John Law actually originally designed back in back in the 17th century, in the late 1600s, he was writing about this stuff. So when rates go up at some point, and these bonds get crushed in value, because of course the longer term your bond is, the more affected it is by interest rates. that's when gold will really go crazy. And that's what in the 70s, right? The nominal rates went up in the 70s and gold went up. And it was the same moment that rates hit 21%, that gold hit 875. And I read all these reports coming out of the Wall Street banks saying, oh, rates go up. What happens is people sell their gold to buy yielding assets, and so gold goes down. And again, they don't look at even recent history that demonstrates that that's not how it works over the long term. What I would say, the only caveat to that story, which I think is history proves is correct and just makes sense, is that if you think about the quantity of dollars out there, about 4 trillion of them, and the number of dollars owed in total debt, it comes about 90 trillion.
That's
about
right.
that. And that $90 trillion demands interest payments all day long. And you say, well, where do you get the money to pay the interest on $90 trillion? So you can have huge short squeezes in the dollar where it goes up in value because of that dynamic. But and we saw this again in 08. When the crisis first started, gold got hit. But the second the banking system started teetering, right, that gold got a huge bid.
Yeah.
Right, because then it's like, wait a second. Because the reality is, if the state allows any deflation at all, the first thing that happens is the banks go under, and the next thing that happens is the government goes under because no one pays their taxes. They can't maintain the bonds. The bonds default the Federal Reserve, and then the dollar disappears. So they literally cannot allow it to happen. Now, it will happen at some point. Right now, we'll put it this way: in 1969, gold backed the Federal Reserve by about 10%. Gold was $35 an ounce. By the time we get to 1980, with interest rates at 21%, gold backed the currency by the monetary base by 100%. It actually hit 133 for a brief moment, overbacked it. Today we're down to about 7%. I have a series of the Federal Reserve going to 1914 and Bank of England going back to 1704, and the average of that number is around 33%. It's not 100%; it's around a third, and we're at around 7%. The average,
and that's without the entitlements, right? That's all the promises.
Well, not only that, but again, really until the 1950s probably, those other 2/3 of assets again were commercial bills. Or very short-term government bonds. So where now we have long-term bonds, it's not going to be a third. It's going to be a lot higher than that in the liquidation period when it actually happens. And so gold is going to go to a place where it's going to back the monetary base by more than a third, right? Probably a half. Or in a panic in 1980, it reached over 100%. And then you get gold prices up at $24,000 an ounce and higher. And you can't say that in polite company because people think you're crazy.
No, and and even now, people are going to have listened to that, and the thing that they will have taken away from it is $24,000 an ounce. Right? That's the thing. Right. But it's such a great way of looking at it and saying that it's not about, it's not about gold. It will take you $24,000 to buy an ounce of gold if you want to buy one. That's what's happening.
And by the way, oil is not going to be $40 a barrel, right? Or whatever.
But it's this is the thing that I struggle with, and I understood the long dollar thesis for 2015. I was with that, and a year ago probably I kind of just thought they're not going to let this go any higher because the pain it causes is too great. And the Achilles heel for that is exactly as you said. It's a short squeeze of some sort, and I have to believe that if you have a short squeeze in a commodity that you can conjure out of thin air, that short squeeze can be dealt with pretty quickly if needs be.
Well, that's what Bernanke said,
swap
right?
Lines
we have a technology called the printing press.
Exactly right. So that's how I see this play. Is you do get that short squeeze. The answer to it is okay. We need to fill it with more dollars. And once that happens, people suddenly get the joke and say, "Oh, wait a minute, you mean?"
Yeah, that's a good point. Let me go back again to the Mississippi bubble because again, it exhibits everything we're living.
It's a subject dear to my heart.
And as you probably know, the Mississippi Company ran from about 200 leave at the bottom, I think, to over 10,000 over a 3-year period. At the first big correction, it went from 5,400 down to about 48. John Law ran out and he guaranteed the notes. He said the bank will buy back any and all notes at 5,000 or thereabouts, right? And we're saying, well, Greg, I got a put option. All right, I'll bid up. So the thing immediately jumped over that strike price and kept going north. The next big correction, when it went from over 10,000 to 9,000, John Law said, hey, I'll do the same thing. Right? Only this time, it was okay, give me the money. Right, and then he had to issue $1 billion new notes at his bank, and then the currency collapsed. So he stabilized the price of the asset, but the currency collapsed. And I do wonder sometimes whether the guarantees were so successful in 2008. They were very successful.
No two ways about it.
And when the next panic comes, Janet Yellen will look in her toolbox, or whoever the current person is at the time, and they'll say, hey, guarantees work.
Yeah.
So we'll guarantee not 7 trillion this time, it'll be 14 trillion we'll guarantee. But what happens when they say, okay, yeah, thank you, Mr. Federal Reserve, let's pay up. You can stabilize the price of the assets in nominal terms, but you might not be able to stabilize the currency at that point. So it would be a wonderful echo of history if it happens. Again, does it happen next time, or do we have one more cycle to go? That's a harder question to answer. But certainly, these credit bubbles are not, again, linear. You can't just lop off 2 zeros and say, okay, well, if we're going 10% a year, we just start over at a lower base and keep going. They accelerate until they collapse. And so we're at that bend of the curve acceleration period where again, the end is not. Does that mean next month or next year? I don't know.
But this is exactly the problem, right? I mean, I think I've been struck actually traveling around the last couple of years by the fact that it's now the end game is pretty much accepted.
Right.
People generally there's not so much pushback anymore.
Right.
It's really an argument about but don't worry about it yet. We've got a couple more years of this, which is great, right? But if you want to get into that mindset, but of course. You miscalculate slightly. Chuck Prince, he stays one song too long when thinks the music's playing and it's someone outside with his iPod. Boom, it's over.
Well, you know the story of Isaac Newton.
Yeah,
he was in the South Sea bubble, and he knew it was a bubble. He made a lot of money. He sold out. He did it just right. His friends started getting much more money than he had. And he was annoyed by that. He was brilliant. His lesser friends. So he jumps right back in, right at the top of the market, and loses everything.
Well, this was I keep talking about this, but the greatest thing I ever heard Stan Druckerman say, he was being interviewed by Ken Langone at a private gathering, and he was talking about how he jumped into the internet bubble and lost $1 billion of Soros' money. Right? And he said, I sat there and watched all these young kids jumping up and high-fiving like all this money. But the killer question, Langone said to him, so what did you learn? And his answer was just brilliant. He said, nothing. I knew I shouldn't have done it, and I did it anyway. Right. So I didn't learn anything. And I thought that was so brilliant. And obviously he did learn, but he learned the wrong lesson at the wrong time. But it's that I get that this is all going to fall apart and it's fumes and it's rubbish, but I can still make 5%. Yeah, that's a hell of a risk reward proposition.
It's tough. I mean, and it's hard for professionals, right? Yeah. If you're not a professional bringing in money, you can take the long view and get out, and it's going to be soon, and if it's not soon, that you'll win in the end. Right, it takes longer than you thought. The longer it goes, the worse it is, and so in some sense, getting out now pays for itself. But if you're in the trenches, working in the industry, it's much harder to time that. Yeah. So it's unnerving.
Well, so there are going to be a ton of people watching this who have suffered through the mining shares. The pain since 11, and the breaks in the clouds that then get shut out again, and and a lot of them will have been trading in juniors thinking, I'm going to get rich with this thing and been just battered. I mean, can you give people doing that some advice as to how to manage probably the emotions of it the best? Is it about position sizing? Is it about, how do you think about that in terms of managing that risk?
Yeah, position sizing is key, right? I mean, they say don't take a position that you wind up sleepless thinking about all night long. And the junior should not be your only gold exposure, right? It should be part of a portfolio. I mean, gold itself, bullion, at this moment in history, ought to be a big part of your portfolio. Yeah. And gold, the purchasing power is very stable. I mean, you're not going to make 10, 20x in purchasing power. In gold, you might make it in nominal terms, but not in purchasing power. You can get that in the junior mining shares, but to do that, you take on much more risk, obviously. And so I think position size is key. And I also think rebalancing is key. I also think that, and again, an awareness of fallibility is key, right? Man is mortal and fallible and all those things. So you can't come out and thinking this is the answer. Yeah. And people do that. I feel that way, right? But I try not to act that way. Yeah. Because you just never know how long they can. These things are parabolas. They're curves. They're fractals. It's hard to know where you are in a fractal, right? You know what the big picture is, but it's hard to know precisely what your position is, and so. I think history tells you it's the right trade, but you have to approach it from a position of humility and not otherwise.
Yeah, it's such great advice. So, just to finish up, we spoke at the beginning. We talked about the performance of gold in a credit bubble. And I wanted to come back to that. You said we can talk about it later if you like.
Sure.
I'm thinking I'm definitely coming back to that. So yeah, if you can just expand on that and talk about it, because that's where we are. I don't think there's any argument that we're in a credit bubble.
Yeah.
The only argument is how severe it is and when it burst. But so just talk a little bit about.
Well, again, as I mentioned before, but go over it again, and that is what the discount rate, interest rates, and they're two different things, but they're very closely related. Is the key to all economic planning.
Yeah.
Right? How to what extent do you discount future value, and the banking system operates to squelch that discount rate artificially. It should move naturally, right? As people become wealthier, they have less immediate needs, so they're willing to wait for the future, and that naturally lowers the discount rate, and that allows more complex products, longer supply chains to come online. When the bank does it artificially, again, you get overcapacity in long term, in heavy capital, in distant capital distant from the consumer, and again, gold does not participate in this, and so other things go up in value: stocks, bonds, real estate, all those things that have long term cash flows go up in value, and gold doesn't. And so you always see gold falling as commodities in a credit boom, and this was true in 2000, 2008. Right, gold went up in nominal terms, but if you price it in oil and things like that, it went down. And so in a boom, gold always underperforms, and it's the exact same reason in the bust when the bank system blows up and interest rates spike, all those long-term cash flows get devalued to huge extents, and gold doesn't. And it's George Gilder talks about how gold measures time, right? And time is the same for a peasant as an emperor. We have so much time, and gold measures this. And what he means by that is that it's immune to this shift, or relatively immune to this shift in discount rates, in societal time preference, and it's also immune to technology, in the sense that as technology increases, the marginal cost of production fall for everything, and also efficiency in use. So cars used to be a big hunk of steel, and now it's mostly plastic and a little bit of steel, right? Whereas gold mining is a tiny percentage of the above ground supply. All the gold ever mined in the world, most of it's still around. So the marginal cost of production has very little influence on the price. And what that means is it causes, over long periods of time, it causes commodities to fall against gold. Again, you see big bubbles, but
you've put that chart, and it's a fantastic chart. Yeah. We'll put it up here so that people can see it.
It's sort of, it's funny because I deduced that idea, and then I was looking for the data to see if it was that right or not. And there it is. It's an incredible chart. But it has all sorts of implications for gold mining, which is, again, if the gold commodity ratio is always rising over long periods of time, it means the gold in the ground is always increasing at a certain rate. And it has profound economic consequences for gold mining. But again, because gold resists this change in technology, it really is a constant, not just in terms of value in the present, but value through time. And that is what gives us magic. Again, back to George Gilder, he makes the point that the key to technology is the signal to noise ratio. Right? When you have your voice on a copper line, the copper is volatile, and so it degrades over time. When it's going down a fiber optic cable, it is less volatile. You can send more signal down that line. And his analogy, which I think is a very good one, is that gold has very little volatility, and that's what makes it such good money. It's this idea that, gold is anachronistic because we can do more modern things. No, the very beauty of it is that it is so stable, and nothing happens to it, and things happen around it.
Well, that's it. That to me is the key. It sits at the middle of all of this, and it just sits there, and it doesn't. You're right. It doesn't do anything, and things rise and empires fall, and all this stuff happens around it, and it has for thousands and thousands of years.
Vladimir Lenin said he wanted to coat all the public laboratories with gold. That's what I want to do with gold, right? And I love that because he really understood gold. He was a very subtle, bright guy. So what does that mean? I mean, it wasn't that people wouldn't steal the gold because the police would catch them. The idea was that gold be removed as this stabilizing force, that the self would be gone, that we'd all be wonderful communists just working for the aesthetic of working and producing. And so you wouldn't need gold anymore. It's a very subtle point. Of course, it's completely wrong and nefarious, but it really goes to the crux of what gold is. And it's so impressive. Marx wrote that gold is money is not by nature gold and silver, but gold and silver are by nature money. I mean, they understood these things in the 19th history. Now, those two characters tried to overturn it.
Yes,
but at least they understood with that which they were trying to overturn. Whereas,
they understood the importance of being able to overturn it in order to achieve what they wanted to achieve.
Exactly, and then you have Janet Yellen saying nobody understands gold.
Yeah.
And you think, well, you know, if Lenin and Marx and Menger, and everyone, I mean, that's not just simply not true.
Yeah.
What to do with it, people have disagreed on, but what it is, historically, there was very little debate about. It was pretty clear. But again, by the end of the 19th century.
Yeah, it's such a fascinating subject to me, and getting the chance to talk with someone like you that thinks so deeply about this is such a rare treat, because it is something that people fixate on the price, and they fixate upon, you know, where's it going to be? Are we going to 10,000? Are we going to 5,000? And you know, if history teaches you anything, it's exactly what you've just expanded upon so beautifully, is that it is, and it has its value, and it will maintain its value, and you can count on that.
Right.
What else can you really count on in this world? It's a bizarre world we live in.
It's bizarre, and again, I mean, in a way, if you're young, you shouldn't have that much gold, I guess, because you should be taking risks, I suppose.
Yeah.
If you're old, if you're a pension fund, these pension funds should be chock full of gold, right? Because their function should be to preserve purchasing power. That's their function. Instead, they're buying subprime auto debt.
Yeah.
It's unbelievable. Yeah. I know why they do it, because they don't know anything, and some hedge fund guy takes a nice dinner in New York and plies it full of wine, and the consultant okays
and they need to make 7%
off, and
a
then
year.
it works. Well, right, but they don't understand the deeper thing. If you actually want to provide for your old age, when you're old, you should own gold, because it stabilizes your purchasing power. It may go down in price, but it's going to stabilize your purchasing power. I mean, for example, it's so clear. If you look at the standard deviation of oil in terms of dollars since 1974, it's 61%. It's 40% in gold terms. So again, gold has the effect of squelching the price changes of commodities. And then, of course, all products are eventually derivative of commodity prices. All products start as commodities. So that is its function. And so few people, I think you're right, understand what its function is.
Well, if they didn't before, they certainly understand it a lot better now. Dan, thanks so much for joining me. I've been looking forward to this for ages, and it was so much fun. Thank you.
Well, thanks for having me.
You know, I've waited a long time to talk to Dan Oliver, and hopefully through that interview you could see why. You know, he thinks about gold in a very, very different way to a lot of people, and his perspective on history, he's an incredibly well-read guy, gives him a special understanding of gold's place at the centre of the monetary system. Throw in the fact that you get a few lessons in how to mentally manage a position of small cap gold stocks, and to me that was an invaluable conversation. I hope you guys thought the same.